Welcome to the deep dive. Today we're digging into something, well, fundamental, how central bank decisions on monetary policy actually ripple through the economy. It affects everyone, really.
It absolutely does. Think of it like the economy's plumbing system. These decisions control the flow, the pressure. It impacts your savings, your loans, everything.
And we're looking directly at the source today, a document from the Reserve Bank of Australia called The Transmission of Monetary Policy. So this is straight from them explaining how it all works.
Yeah, and our goal here is, well, to unpack that for you. We want to pull out the core ideas, the two main stages, the different ways policy gets transmitted without getting lost in, super technical jargon.
Exactly. We want you to walk away with a really clear picture because let's face it, monetary policy can sound a bit dry, maybe a bit intimidating.
It can, absolutely.
Cool.
But the mechanics are actually quite fascinating when you break them down.
So we promise to keep it understandable, maybe even a little surprising, how these big decisions connect to your everyday life. Okay, let's kick things off. Stage one. How do the Reserve Bank's actions actually move interest rates?
All right, that's the first domino. The document really zeroes in on the cash rate. That's the rate banks use for lending to each other overnight. Sounds obscure, maybe,
A little bit, yeah.
but it has this huge influence. It's like the anchor point for pretty much all other interest rates in the economy.
So the rate on your savings account, your mortgage, business loans, they all kind of take their cue from this one single rate the RBA sets.
Largely, yes.
Yeah.
It sets the benchmark. Now, the RBA does have other tools in its kit as well.
Oh, yeah. Like what?
Well, they mentioned forward guidance. That's basically them signaling their future plans,
Mm-hmm.
trying to guide expectations,
Ah, okay.
and also buying government bonds or providing banks with low-cost funding. These actions tend to nudge those longer-term interest rates more directly.
Got it. So the RDA sets the tone with the cash rate and these other tools, but they're not the only thing determining the rate I actually get offered on a loan, are they?
No, definitely not. The document's clear on this.
Hmm.
Market conditions matter, how much competition there is between banks, and importantly, how risky the lender thinks the loan is.
Right.
All those factors create what they call spreads, the difference between the benchmark rate and the actual rate you pay or receive. That's why different banks might offer slightly different rates.
Okay, that makes sense. So stage one, RBA influences the general level of interest rates. Now, stage two, this is where it gets really interesting, isn't it? How do those rate changes actually impact the real economy? Spending, investment,
Yeah.
inflation.
Precisely. This is about how the signals from the financial system translate into actual economic behavior. Let's use the RBA's example.
Mm.
Imagine they lower interest rates.
Okay.
The main idea is that this tends to boost what economists call aggregate demand, basically, the total amount of spending in the economy.
Yeah, how's that work?
Well, if borrowing is cheaper, households might be more inclined to take out a loan for a car or a house. Businesses might find it cheaper to borrow for new equipment or expansion.
Right. Lower mortgage payments free up cash, cheaper business loans make projects look more attractive. Seems logical.
It is, fundamentally. But, and this is a big state, but the document highlights these effects take time. There's a lag.
A lag. How long are we talking?
It can be quite significant. The RBA suggests it might take, one, maybe even 2 years for the full impact of a rate change to work its way through the economy.
Wow, 1 to 2 years. That's longer than I might have guessed. So decisions made today are really shaping the economy quite far down the track.
Exactly. And there's uncertainty, too. The RBA acknowledges that the exact timing, the exact size of the impact, well, it can vary. It depends on lots of other things happening in the economy at the same time.
Okay, so it's not like flicking a switch, more like turning a big, slow-moving ship.
That's a good analogy, yeah. Now, tied into all this is something called inflation expectations. The document mentions this quite a bit. Why is that so important?
Good question. Expectations can be powerful. If people and businesses expect prices to rise sharply in the future.
They might change their behavior now.
Exactly. Workers might demand bigger wage increases to keep up. Businesses, expecting higher costs and seeing strong demand, might raise their own prices more readily. It can become a bit of a self-fulfilling cycle.
So what we think will happen with inflation can actually, well, make it happen to some degree.
To some degree, yes. And that's why the central bank having a clear inflation target is so crucial.
To manage those expectations.
Precisely, by saying, look, our goal is to keep inflation around, say, 2–3%. And acting consistently to achieve that, the RBA aims to anchor those expectations.
Makes sense. If everyone believes inflation will stay low and stable, they can make long-term plans for saving, for investing with more confidence, less uncertainty.
Right. Okay, so we have the two stages. RBA actions, Interest rates, economic activity, and inflation. And we know expectations matter. Now, let's dive into the specific ways or channels this transmission happens. The document outlines a few key ones. First up, the saving and investment channel.
Yes. This was pretty direct. Think about saving. If interest rates on your deposit account are really low.
The reward for saving isn't great.
Exactly. So the incentive to save goes down, and maybe you decide to spend that money instead. That boosts consumption.
Okay, and the investment side.
Lower loan rates make borrowing cheaper. So households might borrow more, maybe for housing, pushing up demand there. And for businesses, it's similar.
Cheaper to fund projects.
Right. Lower borrowing costs make investing in new machinery, buildings, technology, whatever it is, more attractive, especially if they also think lower rates are going to boost demand for their products anyway.
So lower rates kind of grease the wheels for both spending and investment through this channel. What about the next one, the cash flow channel?
This focuses on, well, the actual cash people and businesses have available day to day.
Right.
If interest rates fall and you have existing debt, especially variable rate debt.
Like most mortgages in Australia.
Exactly.
Right.
Your required repayments go down.
Yeah.
That leaves you with more cash in your pocket each month.
Which you could then spend on other things, more disposable income.
That's the idea. But the document notes there's another side to this coin.
Oh.
Savers. People who rely on interest income from deposits. When rates fall, their cash flow actually decreases.
Ah, right. So borrowers have more cash, but savers have less. It cuts both ways.
It does. However, the RBA's analysis for Australia suggests that, on balance, the positive effect on borrowers tends to outweigh the negative effect on savers. So overall, lower rates usually increase spending through this cash flow channel here.
Okay, interesting balance there. Next up, the asset prices and wealth channel. This sounds like it could be quite powerful.
It can be, yeah. Lower interest rates generally tend to push up the prices of assets. Think houses, shares.
Why is that?
Well, one reason is that future income expected from those assets, like rent from a property or dividends from shares, becomes more valuable in today's money when interest rates are lower. It's a valuation effect. So investors are willing to pay more.
Gotcha. So lower rates can mean your house or share portfolio is suddenly worth more, even if nothing else changed.
Potentially, yes. And this increase in perceived wealth has a couple of effects. First, if your assets are worth more, you have more collateral. That can make it easier to borrow money.
Ah, okay.
Second, there's the wealth effect itself. When people feel wealthier because their assets have gone up in value, they tend to become more confident and, well, spend more.
Yeah, I can see that. Feeling richer makes you more comfortable opening your wallet.
It often does. So it boosts consumption and maybe even a housing investment again.
Makes sense. Okay, final channel, the exchange rate channel. Crucial for Australia being such an open trading economy.
Absolutely. This is about how our interest rates compare to those overseas. If the RBA cuts rates here, making them lower relative to, say, the US or Europe,
Investing in Australian assets becomes less attractive for global investors, lower returns.
precisely. So demand for Australian dollars might fall. And if demand falls, the value of the Australian dollar tends to decrease on foreign exchange markets. Our dollar weakens.
So one Aussie dollar buys less foreign currency. How does that impact things here?
Two main ways. A weaker dollar makes Australian exports cheaper for overseas buyers. So potentially, our export industries get a boost, which helps economic activity.
Okay, good for exporters.
But the flip side is that imports become more expensive for us. Anything we buy from overseas electronics, cars, clothes, even components used by local manufacturers costs more in Aussie dollar terms.
Right, that coffee machine made overseas or that holiday booking suddenly pricier.
Exactly. And because imports become more expensive, this directly pushes up inflation here in Australia. So the exchange rate channel can stimulate activity, but it also adds to price pressures.
So it's a bit of a double-edged sword, that one.
It can be, yeah. Central banks have to weigh those effects.
Okay, wow. We've covered a lot there. Just to recap, it's basically a two-stage process. The RBA uses its tools, like the cash rate, to influence interest rates generally.
Right, that's stage one. And stage two is how those interest rate changes then ripple through the economy via these different channels, saving and investment.
Cash flow, asset prices and wealth, and the exchange rate.
Exactly. Affecting spending, investment, jobs, and ultimately inflation.
And it's complex. There are lags, uncertainties, and all these channels interacting. It's not simple mechanics.
Not at all. But having a handle on these basic mechanisms, these transmission channels, is really key to understanding why central banks do what they do and how it shapes the economic environment we all operate in.
So here's something for you, the listener, to think about. As you hear about interest rate decisions or see economic news, try to map it back. Which of these channels might be most active right now? How could they be influencing your own decisions or the businesses around you? Observing the economy through this lens, well, I can make things a lot clearer.